pleased to have with us today Sylvia Jablonski, Managing Director at Direxion Investments. Sylvia, welcome to the show.
Thanks for having me, Julie. Great to be here.
Coronavirus has upended daily life and specifically how we work. One of the timely ETF launches this year is the Direxion Work From Home ETF, ticker symbol WFH. The trend of the dispersed workforce was well underway before coronavirus. Do you think investors understand the longevity of this huge shift beyond coronavirus?
I think that's a great point, and I think that the trend to work from home was starting before the coronavirus and the virus and sort of all the risks and bad news that came with it just accelerated the whole thing. So we've been hearing for the last few years about companies trying to separate employees anyway, or just utilize space a little bit better and having rotations where people work from home one day a week. A lot of the fintech types of companies do it anyway, just for life flexibility. Now fast forward, there's a major virus and we're all forced to quarantine at home. And all of a sudden the trend just takes off probably a couple years ahead of its time. So I think that this is something that is going to stay. There are a lot of surveys out there, whether it's PwC, Salesforce, where anywhere from 50 to 70% of corporations surveyed believe that they will have at least part of their staff at home. The 70% number was a hybrid situation where some will be in, some will be out. And then, just most employees in general think that their future looks to be partially at home, at work, whatever it might be. So I think that this trend is really here to stay. And it's not about, exercise bikes and watching movies and Netflix and eating popcorn at home. Like that's not what this is. This is about ways to efficiently support remote technology and remote flexibility.
Shifting gears just a little bit, Chinese stocks have seen a nice upswing. For bulls, Direxion offers CHAUYINN and an internet sector fund, ticker symbol CWEB. What do you think is going on with China?
So China is really interesting to watch because they went through all of the COVID outbreak before we did. So what's happening there is that although they've had some recent setbacks, their economy is more or less 80 to 90% back up and online. So, what happened there, I think, is that the Chinese broad-based indices got hit just like our indices did. And as things started to open up, whether it was factories that export parts to the US or, local restaurants, whatever it might be, they started to open up and they're starting to see consumption again. So the numbers out of China, the industrial numbers, the PMI, a lot of we've seen a lot of positive momentum come out of the economy there. PBOC, Chinese government, is supportive of the markets. And so what you have there is essentially the markets jumping back on the bandwagon that they were on before, which was meant to be a high GDP growth. So, the GDP number was absolutely terrible in Q1, and in Q2, that number picked up to make up for the almost 3% loss in the first quarter, picked up almost another 3% in the second quarter. So that coupled with, the slow reopening, coupled with the massive e-commerce population that they have, the online consumer is growing, the consumption of technology is growing. China is a really interesting place to look for investors.
The technology sector has been a great trade. The Direxion Daily Technology Bull 3X ETF, ticker symbol TECL, has gained 550% over the past 5 years. TECL has easily outperformed popular stocks like Amazon, Apple, Facebook, and Netflix. It has also outperformed its under-leveraged counterpart XLK, which gained 170% over the same 5-year period. TECL is ahead over 3 times XLK's gain. That outperformance might be perplexing to some observers. What do you think is happening here?
So this is really interesting, and it's a good sort of lesson about how levered and inverse ETF products work. So it depends on which time period you look at, because so TECL tracks 3 times the daily performance of the technology index. So XLK is a popular one beta buy and hold ETF that people use to benchmark or make comparisons to one third of what TechL would do on a daily basis. So with TechL, when you had a trend, which pretty much after March 23rd, a lot of the top tech names started to rally again. So Apple, Microsoft just absolutely started to crush it and take off. And they have a heavy weighting in TechL. So getting 3 times daily exposure day after day of positive returns and compounding led to TechL outperforming by more than 3 times the underlying index, which it tracks. The other thing to note here, though, is that this worked really well because with bull funds, trend is your friend. Although we had volatility, overall, the trend was so high in the specific tech names that pushed the sector up. However, if you look in March, investors should be wary because any kind of uncertainty and range-bound volatility can actually decay the earnings in that investment. So it's important to note that XLK is sort of a set it and forget it exposure to technology. It's not our product, not an advertisement, but it's appropriate long-term hold. TechL is for investors who are sophisticated and understand the 3 times exposure. They understand the risks and they understand essentially what they're getting. So the idea is that's a product that you can hold for a longer period of time too, but you have to actively daily monitor it. So that's what's key there. But yeah, and to bring it back to the work from home we started with, WFH, work from home ETF, is an awesome way to have a set it and forget it satellite allocation to the technology that will support remote work. And TechL is a great way to trade on the short-term trends that are in the technology sector.
One final question for you. The Direxion Flight to Safety ETF, ticker symbol FLYT, uses a novel strategy offering hedges or protection to investors that may be a little worried about market conditions. Can you tell us a little more?
Sure. So we created FLYT because, after years of being out in the field, we've talked to investors and advisors a lot about, hedging and how do they view hedging and do they hedge and what do they do? And overwhelmingly investors either, sell and go to cash, or they look at alternatives, or they look at, tail risk strategies, or they try to time when they should sell something. And all of those things come with complications. They come with tax events. They come with, expenses like tail risk strategies, and a lot of the alt funds out there are super expensive. So, and you don't participate if the market goes up. So that's the big thing. You have this one thing that only works if the market sort of flops, right? Which is great, but over time, the S&P 500 has an annualized positive return. So you want something that will allow you to protect and participate. So FLYT is 3 asset classes, non-correlated to each other, non-correlated to the S&P 500. It's gold bullion, long-term treasuries, and large cap utilities. So you have this product, all those 3 asset classes in one, which serves as a ballast, but also allows you to participate in the market. And by the way, 2 out of the 3 have historically paid income along the way. Right now, there's no income in treasuries, but hopefully at some point again, when we see dividends and coupons paid, we'll generate income again. But either way, you're getting participation in equity markets and a ballast because of the non-correlated nature of the ETF.
Sylvia, we appreciate you stopping by today. And to learn more about Direxion, visit direxioninvestments.com. I'm Julie Gaertner with ETFguide TV. Thanks for watching.